So we're going to start talking about the Tesla SpaceX merger a little bit more going forward.
In this episode, we want to talk about two things. One is our preliminary valuation, the way we see it, and then also give some fundamental reasons why I think this makes a lot of sense. This is not even a podcast. It's August 13, 2026. It's trimmed out for the year, we're down 15%. The market's up 12, around going by 27%. So SpaceX and Tesla merger is a big topic in the Tesla community more than probably anywhere else. And I think I want to take the wind out of people's sails a little bit because a lot of Tesla people are hoping for some sort of premium or something. And if you look at the valuation of both stocks right now, and if you look at my model, and you can obviously have different models, but roughly what I see is actually that the Tesla price right now is pretty fair given a potential Tesla merger. Now, it all depends on how the stock will move at the announcement of the merger. So if SpaceX is flat, then I think we have about maybe 10% upside. If SpaceX is up, then we have more upside, and if SpaceX is down, we have less upside. And this is based on the valuation that I've given these two stocks. So I have my model. I have about $210 fair value for SpaceX, and I have about $570 fair value for Tesla. That gives you about a 55-45 split in terms of market cap. So meaning the new entity will be 55% SpaceX shareholders and 45% Tesla shareholders, to combine market cap given my valuation, not the actual market cap of my valuation, will be about $5.4 billion. Trillion, I'm sorry, what am I saying? $5.4 trillion. At current prices, this is, of course, lower. Now, the 55-45 split is, again, based on fair value, based on what the businesses are carrying right now, what the forward-looking projections are, what at a 22% discount rate. By the way, I'm using the same discount rate for both companies. So there's a lot of moving targets here. You can debate the discount rate. You can debate the upside for Cybercab. I have almost no value for Optimus in this equation. You can add, $100 a share for Optimus if you want. I'm not doing that because we just don't have any visibility right now. This is not a business that you can actually put any value in my opinion. On the SpaceX side, the valuation hinges on the compute. I basically split the business in two. So there's Starlink and there's compute. I bundle the launch business with the Starlink business for reasons that I could make a number of podcasts just talking about the model here. So I don't want to go into details. I'm also not publishing the model. I think this is proprietary information right now. I will publish it at some point and open source it, but right now, or maybe I'll open source it. I don't know. Actually, it'd be interesting to get feedback. So I'll think about it. Put some in the comments if you want this model to be open sourced, and then we can talk about this. But roughly, again, I have about 1 trillion value. I have about 500 billion in Starlink value, and about 1.5 trillion or so in compute value. So something like 2 trillion. Actually, at $200 a share, it's more like 2.6 trillion, 2.7 trillion. So it's 2/3 compute, 1/3 Starlink, and that's you can see already where the risk is in SpaceX. Of course, it's the compute side, and the risk here is not so much the ability of SpaceX to deliver compute and win in the marketplace. It's more what kind of price can they ask for? What is the true value of tokens, given that we have an overpricing of tokens, lack of profitability, lack of value creation in the market. Lots of people are using coding agents, but where's the value? Are people actually firing people if they use workflow management tools? We have stocks like Atlassian, almost back to flat, or still down, but not so much. A lot of SaaS stocks are back, have recovered quite a bit. I mean, you have to see something give, right? You can't have the same amount of spending and then add trillions of dollars of new spending for tokens and then not have massive growth or
or if you don't have the growth, you need the cost cutting. Like something has to give. People are not getting fired, as far as I know, not more than usual. So there's a bit of a question. Okay, what's the value of this whole AI thing? Now it will pan out in the long run. We always underestimate the impact of technology, so for sure it will pan out. But in the short run, we're not so sure, and that's when we do valuations, we have to take that into account. So the way I think about this whole SpaceX situation is, I assume about 2.5 trillion in spending on workflow management tools in 2030, and I give SpaceX about 30% market share of that. So that's how I think about it. Very simple, the gist of investing is to keep it simple, and it's hard to keep it simple, of course, but that's kind of the way I think about it. On the Tesla side, there's robotaxi, there's also autonomous trucking, and then there's the car business, there's FSD, and then there's the energy business. It all gets to about $570 a share. So having said that now, when we do the merger, we have to think about, okay, we have fair value of, let's say, $210 a share for SpaceX. SpaceX is $140 right now. So it's about, 25, 30% below its fair value. And we have a 570 fair value of Tesla. We had 330. So that's, about 50%, 60% below its fair value. So there's definitely some upside for Tesla, and that's why we think there is upside for Tesla. But then that hinges on how SpaceX trades. If SpaceX trades down 15% on the merger announcement, and we have a fixed 55-45 share distribution, then you're just going to get less as a Tesla shareholder. SpaceX is up, you're going to get more. There's also regulatory risk, so the risk-off spread will be relatively high. So I guess having said all of this, I don't think you're going to have a lot of a pop on the merger announcement. That's all I'm saying. Now, that doesn't deter us, actually. We're Tesla shareholders, and we're not SpaceX shareholders, and we actually want this merger to happen because, and here's why. And again, keep it simple. It's hard to keep it simple, but we're trying to do this. The way we see the future of these two companies is they're both AI companies. SpaceX is developing the compute and the workflow management tool, which is Grok, and Tesla is delivering the physical AI tool. We have two different directions of AI, which is the physical AI and the workflow management tools, which are built on large language models. The reason I call them workflow management tools is because the big value here is not ChatGPT or Grok communication or doing it like a Google search. The big value, of course, is when we can use them as coding agents, workflow agents, video generation agents, financial analysis agents. So when they actually work for us and deliver tasks, so that's why I call them workflow management tools. And by the way, just as a caveat here, you could have Grok also managing the robotaxi fleet. So we have also an overlap here of workflow management tools that can actually manage physical AI that executes workflows in the physical world. But fundamentally, these are two different directions that the both companies took. Tesla took the direction of vision-based physical AI very close after AlexNet and the whole thing started with AI, because they bet on vision. Vision was the first big solution in AI, and it drove a lot of value creation, and I think it gave us FSD. The ChatGPT moment showed us that we can have also workflow management tools, operating systems, smart, some sort of AGI, digital AGI, whatever you want to call it. All these tools like Code, Claude Code, and Codex, and ChatGPT, and Claude, and Grok Heavy, they're all in the same realm of large language models, foundation models, call them foundation models, which can do a lot of things for us, particularly manage workflows in the digital world. So those are two different paths that SpaceX, which merged with XAI, and XAI was founded on that, is on that direction, and physical AI, which is Tesla, which is FSD and robotaxi and cybercab, and then Optimus. The Tesla path is vision heavy. It's not only vision, but very vision heavy and simulation heavy, video generation heavy. So what we need is video generation, which we already have. Ashok has talked about it many times, that we are learning from video. And maybe just as a small interlude here, the way we see the robot learning pipeline going forward is that you learn from internet scale video data. That's what gives you the spatial intelligence that you need, and then you fine tune on skills for whatever the robot needs to do. Something along those lines. At the next level, we're going to see learning from experience, which is what Richard Sutton has talked about last year in his seminal essay, The Era of Experience. He was invited as a keynote speaker at NeurIP. So I think the industry is taking it seriously. Just recently, I attended a podcast with the latent space guys, and they spoke about the next trend is sort of continuous learning, which is in that same realm. Of course, continuous learning doesn't just mean learning from experience, or it could mean learning from experience in the digital world also. But the point is that we have a fleet of robots that interacts with nature, with the real world, and that fleet of robots learns from that interaction. So the actual eval is nature and the task to be done, and that is the vision of Tesla, and the vision of SpaceX is to deliver a workflow management tool in the name of Grok, and also to build an AI compute stack on terrestrial and then of course in space. That's actually where the rocket business comes in, which is interesting. If we take these $5.7 trillion that the combined companies will be worth at a fair value after merger, the launch business itself is only packed within Starlink. It's not even that big. Of course, it's crucial. It's absolutely crucial if we want to go into space AI and then really open up space and bring a lot more interesting business cases and all that kind of stuff on the table. We haven't really thought about this too much because it all hinges on Starship, and Starship's a science project at this point. But that's okay. That's not a problem because we have Starlink, we have Falcon 9, we have the compute, we have the terrestrial compute, we have Grok. So there's a lot of value within SpaceX, even without Starship. Of course, eventually we need Starship, not because we want to have that 100x increase in load to orbit. What we need is to have a moat away from the competition. Otherwise, the business could be in trouble because what we don't want to have is a business that competes with neoclouds on terrestrial AI. That's not a good business to be in. It looks good right now, but there's going to be cutthroat competition here. These are very, very well-funded, super fast-growing companies, and they are going to steal each other's pudding or whatever the word is. So that's not a great business. It might be an okay business, but it's not. What we want, of course, is that mode in space, and therefore, eventually we want Starship to work. But it doesn't have to work right now for this merger to work. At least in the next 2 years, we can probably live with Falcon 9 and the terrestrial AI side of things, and Grok, and then of course on the Tesla side, robotaxi, and the car business, and the energy business, and all these other things. So to summarize, what I wanted to do in this episode is sort of start the conversation about the merger. I think we have to have that conversation as investors, of course. It's a good merger. I think it makes a lot of sense, whether it's the TerraFab project, whether it's Starlink on cybercaps, and many other combinations. But fundamentally, again, you have a fully vertically integrated AI company that covers both physical AI and digital AI and compute. So we have these two pillars of AI, which are both based on the compute side, and SpaceX delivers all of these things. And I think that's why this is a good merger. Like I said in the prelude, the stock is most likely not going to move much on the announcement. So you're not going to get that 50% premium that everyone's dreaming of. It's not going to happen. It's just the valuations don't, the math doesn't actually, it's pretty fair value. I would say the market's already pricing a merger. You have probably at best 20% upside in the Tesla stock, but I don't think even you're going to get that because, again, there's a risk-arb spread to be taken into account. There is a potential of SpaceX shares coming down because of the risk-arbs putting on the trade and all that kind of stuff. So it's not so clear, but that's okay. Like we said, we have fundamental reasons to be excited about this. Now, look, if you don't want to be exposed to the Musk AI thesis, then just don't buy any of those two stocks. But if you want to be exposed, it's great to be in a combination. Thank you.